Hello everyone. Today I'll be going around discussing you with fundamental, qualitative, and technical analysis of three Canadian stocks, that is TD, RBC, and Enbridge. The Toronto Dominant Bank, that's TD. Let's go over the fundamental analysis, that's ratios of the bank. The PE ratio 10.04 indicates that TD is relatively undervalued compared to its industry peers. Investors are paying over 10 times earnings, which suggests potential for price appreciation if earning remains stable or it improves. The dividend yield is 4.28%, a strong, sustainable yield that appeals to income-focused investors. It reflects TD's commitment to consistent shareholder returns. Debt to equity ratio is 3.452. The higher leverage compared to some peers typical for large banks, while increased financial risk, TD's strong risk management practices and regulatory oversight helps mitigate concerns. The return on equity is 14.88%. It demonstrates excellent efficiency in generating profit from shareholders' equity. This level of ROE reinforces TD's profitability and management effectiveness. The payout ratio is 42.41%. It reflects a balanced approach. Enough earnings are distributed to shareholders while retaining capital for reinvestment and growth. This ratio signals dividend sustainability. Let's go quickly through the qualitative analysis of TD. The first one I want to talk about is strong management and governance. TD is widely recognized for its conservative risk and cultural discipline with capital management. That's incredibly important, especially in an unpredictable macroeconomics environment like we saw in 2024. The second point I want to go through is resilient business model with diversified revenue streams. TD doesn't just rely on one segment to generate revenue. It operates across personal banking, wealth management, and wholesale banking. A big strength is its US retail banking arm, which now contributes roughly around 35% of its net income. That means TD isn't overly dependent on the Canadian economy. This diversification was a key factor stabilizing earning even with interest rate volatility. The third one is regulatory environment and risk management. TD operates under strict regulatory bodies like OSFI in Canada and Federal Reserve in the US. And in 2024, it passed multiple stress tests and avoided exposure to the US regional bank crisis. The fourth one is competitive position in the Canadian market. TD is the second largest bank in Canada by assets, and it continues to dominate in areas like mortgages, deposits, and digital banking. In 2024, it remained one of the top ranked banks by customer satisfaction and user experience. The fifth one I want to go through is ESG and environmental commitments. TD is also forward looking when it comes to sustainability. It commits over $100 billion towards low carbon financing by 2030. The technical analysis of TD as of June 2nd, 2025. TD's price chart has been forming a symmetrical triangle over the past 18 to 24 months. That's where the highs are getting lower and the lows are getting higher. This pattern shows a consolidation phase on its own. It's neutral, but in TD's case, given the previous uptrend and current indicators, it leans bullish. Simple moving average, that's called the 50 days, excuse me, the 50-day SMA is around 85.78%, well above the 200-day at 82.15. The RSI, that's relative strength index, is around 62. That suggests bullish momentum, but it's not overbought yet. The Bollinger Bands shows that the stocks is currently testing the upper Bollinger Band at 94.77. This band starting to widen, which means volatility is increasing and there is upward pressure building. The MACD, moving average convergence divergence. We have got a clear bullish crossover here. The MACD line is above the signal line and the histogram is in positive territory. The volume is around 106 million. That confirms the price moves are supported by broad participation. In summary, the symmetrical triangle leaning bullish, we have a golden cross on the SMAs, and the RSI shows healthy momentum with with a room to run. The Bollinger Band suggests building pressure, MACD and volume both supports an upside breakout. All signs are pointing towards a potential bullish move in TT stocks. I would also suggest to buy it for long term. Now coming to the Royal Bank of Canada, that's RBC. Let's look at the financial ratios. First, the PE ratio is now 13.97. This tells us that the stocks is reasonably valued. Investors are willing to pay about 14 times earnings, which reflects solid confidence in RBC's earnings stability and future outlook. Next, the dividend yield is 3.31%. That's a strong and steady return for income focused investors. RBC has a long track record of reliable dividend payments, which makes it appealing for long term holders. The debt to equity ratio is 3.775. While it may seem high, it's typically for large banks. What's important is that the RBC has robust risk management practices to support its level of leverage. Return on equity stands at 14.25%. This is a strong performer indicator. It means the RBC is generating solid profits from its equity base, a sign of operational efficiency and effective capital use. Finally, the payout ratio is at 46.36%. RBC is paying out under half of its earnings as dividends, which is a healthy and sustainable level. It allows for both shareholder returns and reinvestment in growth opportunities. Now let's go over some qualitative strengths for RBC in 2024. The first is HSBC Canada acquisition. This deal completed in March 2024 expanded RBC's reach in commercial and international banking. It brought in high net worth clients and boosted their cross border and wealth management capabilities. Second, RBC's strong reputation. It continues to rank as one of Canada's most trusted banks, known for its conservative risk management and a strong capital base. RBC maintained solid Tier 1 ratios in 2024 and remains a favorite among both retail and institutional investors. Th- Third, its diversified business model. RBC isn't just all about retail business or bank. It also operates in capital markets, insurance, and investor services. Fourth, digital innovation. RBC has big strides in technology from AI powered tools to enhance cybersecurity. Over 90% of transactions are now digital, which cuts costs and improve the client's experience. And finally, leadership in sustainable finance. RBC is targeting $500 billion in sustainable financing by 2025. In 2024, it issued new green bonds and highly ranked ESG. Let's take a quick look at the technical setup for RBC as of 2025. We are currently seeing an ascending triangle pattern forming. The stock has been settling higher lows with a flat resistance line around $175.4547. That's a bullish continuation pattern, and if RBC breaks above the level with volume, we could see an upside move towards or above $180. Now on the moving average, the 50-day SMA is $155.66 and the 200-day SMA is $139.41. That's a golden cross which confirms a long-term bullish trend. Looking at the RSI, it's sitting at around $65.04. 65.04, that's a healthy bullish reading. Momentum is strong, but we are not overbought. We are not in overbought territory yet. There is still room for stock to move higher. Next is Bollinger Bands. RBC is trading near the upper band around $175 and the bands are widening. This usually indicates rising volatility and growing buying pressure, again pointing out at potential breakout. As for MACD, the MACD line is at 0.71 and it's above um, the signal line. That's a bullish crossover and supports continued upward momentum. Finally, volume is setting around 90.95 million. That's a strong number. If RBC breaks out above $175 with a spike in volume, that would confirm the ascending triangle and signal institutional buying. So overall, the technical indicators, pride, action, momentum, and trend are all pointing towards a bullish continuing for RPC. I'd also suggest to buy RPC. Now let's take a look at the financial fundamentals for Enbridge Incorporated and why am I assigning it's a neutral rating. Starting with the PE ratio, Enbridge is trading at 23.23 times earnings, which is relatively high for utility and energy infrastructure company. The dividend yield stands at very attractive 5.92%, making it appealing for income-seeking investors. The debt-to-equity ratio is 1.511, indicating that Enbridge is highly leveraged. While this is common in capital-intensive sectors, return on equity (ROE) is 9.08%, which is modest compared to banks but decent for a utility. It also shows that Enbridge is generating reasonable returns for shareholders from shareholders' capital. Finally, the payout ratio is 133.2%, which is a red flag. It means Enbridge is paying out more in dividends than its earnings, likely by relying on distributable cash flow instead of net income. This raises concerns about sustainability of future dividends increases. So while Enbridge provides strong income, its high leverage and payout ratio suggest limited upside and elevated risk. That's why I'm rating it as neutral in current environment. Let's now look at some of the qualitative factors. First, Enbridge's business model is built on long-term regulated contracts covering over 98% of its cash flow. This gives companies steady earnings and protect it from oil price swings. Second is Enbridge made a major move into US natural gas utilities, acquiring three companies from Dominion Energy. This deal makes it the largest gas utility in North America, and it's a clear step forward diversifying away for oil pipelines. Third, the company is investing in clean energy and ESG initiatives. It's putting money into wind, solar, and carbon capture while expanding its green disclosures. This helps it appeal to ESG focused investors. Fourth, Enbridge has a huge advantage when it comes to permits and regulatory access with strong ties to regulators and existing infrastructure rights of way. It's tough for competitors to challenge its dominance and in the pipeline space. That said, the company still faces legal and political challenges, especially with projects like Line 5, which has drawn US state level scrutiny. These issues continues to pose reputational and regulatory risks. So overall, while there are strategic strengths and there are also risks, which is why I'm sitting on neutral. Now let's take a closer look at technical indicators for Enbridge. From mid 2022 to early 2024, Enbridge traded in a flat consolidation range from a bullish rectangular with clear resistance around 54 to $55 and support near $47. In early 2025, the stock broke out at that range and is now trading around $62.73, which confirms a breakout. But what happens next is less certain. Starting with the moving averages, the 50-day SMA is $55.20 and the 200-day SMA is $53.02. So it's confirmed it's a golden cross. That's typically a bullish long-term signal, but it's already been priced in. Next, RSI sits at 66.43, nearing overbought territory. We also see the price hugging the upper Bollinger Band and the bands are expanding. This reflects volatility, often a good signal during breakouts. Looking at MACD, we have modestly bullish signal. The MACD line is above the signal line at 1.01, supporting upward momentum. Finally, its volume is 262.07 million, which is quite high. That spike supports a breakout earlier this year, but the volume has since stabilized, which could indicate that buying momentum is slowing. So that's the conclusion. We have gone through TD, Royal Bank of Canada, and Enbridge, and we have discussed the qualitative, fundamental, and technical analysis um, of these stocks. And I would suggest to buy TD and Royal Bank of Canada, and I would suggest to stay neutral on Enbridge now. Thank you.